Realty Income has agreed to acquire Spirit Realty Capital. Both companies are down significantly year to date and both offering yields between 6 to 7%. In today's episode, we are going to focus on the latest investor presentation about the acquisition. We're going to take a look at how the company and portfolios are combined with both their top 20 clients and their industries. How well are they diversified? We're going to take a look at Spirit Realty as a whole. Was this a good acquisition? The dividend is looking borderline safe, and we're going to run through some important financial metrics. And we will take a very brief look at, before the acquisition, how both Realty Income and Spirit Realty looked up in terms of their reliance on their top tenants, which some of them you could argue are questionable. We're also going to take a look at some financial metrics for Realty Income, and we're going to take a deep dive into Spirit Realty in terms of their balance sheet and their income statement, the health of the company as a whole. And as always, we will run through an updated version of the stock valuation for Realty Income, as well as that for Spirit Realty, to see whether or not this acquisition will really benefit shareholders, or if it is time to start considering other REITs to add to the portfolio, or if we are starting to consider to sell Realty Income. Now, a very quick look at both companies historically. Realty Income down 22% year to date. It has had a horrific year, as have most REITs in the industry. It is towards the 52-week low, which we saw not too long ago, and does offer a yield of around 6.14%. Now, over the last 10 years, shareholders would see their position up around 26%, but that doesn't include those dividends reinvested. Still a fairly poor return, and we can see it did hit the peaks at around $80 just before that COVID crash. Now, in terms of Spirit Realty, that is around 4% down year to date, so slightly better off than Realty Income. It is trading towards the midpoint of the 52-week range and does offer an incredible yield starting at just over 7%. Now, shareholders who have effectively been holding the company over the last 10 years would be down around 17%, which is really poor considering any investment over the last 10 years. You want to be looking at over 100%. So not the greatest. So let's take a look at the acquisition and how this will affect both companies. Now, before the acquisition, very quickly looking at the client diversification of Realty Income, we can see the highest tenant that they had, around 3.9%, was Walgreens. Now, this is one that we have focused on the channel many times. It is questionable in terms of their profitability, but some do argue this could be a strong turnaround play. But as ever, it has been trailing down significantly year to date. The same can be said about Dollar General. And then you do have other companies in here that have been performing poorly over the last few years, but their largest two clients at around 8% haven't been performing that well. And whilst there are talks of bankruptcies, my personal opinion is that they will both be okay, and we will touch upon these again shortly. Now, comparing them to the top 20 tenants that we see for Spirit Realty, we have Lifetime Fitness at 4.3% as the largest part. Again, personally, I don't see the fitness industry going anywhere, whether that's gyms and the likes. But again, there are people here who do believe that with recessions incoming, people may stay away from fitness clubs that do tend to be fairly costly. But again, do bear that in mind when you are looking at your own research. So in terms of these two companies, how is the makeup of their portfolio composition going to be? Let's take a look at the investor presentation that was just released at the end of October. So let's start off with the composition of their tenants. Now remember, you don't want to be investing in any company where their tenants do make up the majority of their portfolio, as you run the risk of, if a company does tend to go bankrupt, then that will affect these essential holders such as Realty Income and Spirit Realty. So straight away, what we see, Dollar General 3.4%. Now, before they merged, as we can see here, Dollar General was around 3.9%, Walgreens at 3.9% as well. So it is in fact going lower, which is a positive in my opinion, as you do not want to have too many clients, in fact, making up the majority of your portfolio. So 3.4% for Dollar General, 3.4% for Walgreens. This is very positive to see. It is coming down. And then you have Dollar Tree, 7-Eleven. You even have the Wynn Resorts, FedEx. So these are all, in my opinion, quality companies. B&Q, Sainsbury's, CVS, Walmart, Tesco's, even at Lowe's. And the top 20 clients, as we can see, 37.2%. And as we can see, exposure reduced in 18 of Realty Income's current top 20 clients. For me, this I would say as a positive. Very good to see. Likewise, when you want to take a look at the combined industries, the idea here is that you are not exposed to too many industries at a large percentage. And what we can see, exposure reduced in 9 of Realty Income's current top 10 industries. Another positive in my opinion. So there are a lot of synergies that we can see. There are a lot of positives to take away so far. Now, for those that are fairly new to the transaction and just want an idea as to what is happening, well, straight away, just to let you know, it is an all-stock acquisition by Realty Income of Spirit Realty, and Spirit shareholders will receive around 0.762 shares of Realty Income for each Spirit common share that they hold, with the ownership being around 87% for Realty Income shareholders and 13% for Spirit. Now, in terms of what they expect the benefits to be, other than those synergies that we saw with the tenants, they do expect around 2.5% accretive to Realty Income's adjusted funds from operation per share, so that is a positive. And again, for those that are not familiar, this transaction is expected to close at the Q1 of 2024. And we did see when this news was released that significant share price drop in Realty Income's price. Now, looking at some other merger details, when we take a look at the synergies that will be combined with these two companies, the enterprise value we do see go to around 63 billion. Properties, as you would expect, going up with the number of properties that Spirit Realty will bring to the table at 15,182 combined. In terms of the portfolio annualized contract rent, and this is good to see for those that aren't familiar with the sizes of either companies, it will go to around 4.5 billion. Now, WALT is essentially the weighted annualized length lease term in the number of years. Realty Income around 10.6, Spirit Realty around 10.3. Positive to see it's not going down too much, around 9.7. And in fact, the occupancy, phenomenal occupancy by Spirit Realty at 99.8%. So overall, we are looking at just shy of 100% at 99.1%. Now, lease expiration percentage through to 2026. Not that much, in fact, so around 15% on average. Very good to see. Client concentration and industry concentration, which we touched upon earlier. This is very, very important. As I said, the whole point here is to reduce your exposure to any client or industry in case things do go sour. 25% it is lowering with their combination. Top 10 industry combination, again, it is lowering to 58%. The only thing we would say here with the investment grade of their properties going down to slightly at 37%. And the property type concentrations, the retail industry going down to 79.9% for those Realty Income shareholders. Industrial slightly increasing to 15.1%. Other at 2.8% and gaming to 2.2%. So there are a lot of benefits that we are seeing so far. And don't forget, we are going to take a look at a little bit more detail of both Realty Income and Spirit Realty throughout the show. And in terms of the size of these companies when they do combine, what we can see here, this shows the largest REITs in the S&P 500 by TEV, which stands for Total Enterprise Value. They were number 7 just after Public Storage, just behind Digital Realty. Now with their combination, they will move to number 4, so they will become the 4th largest REIT in the S&P 500, just behind Simon Property Group, Equinix and Prologis. So that is a bit of information about the merger or the acquisition and how this will affect both companies. Now what we can do is take a look at Spirit Realty and see exactly whether or not the company is something that you would look to invest in as a shareholder. And therefore, if the answer would be no, then you could argue it wouldn't be a great acquisition. But then again, let's take a look. So straight away, dividend safety 50, making it borderline safe. It does have a yield of just over 7%. Market cap of over 5 billion, making it a mid-cap company. Now, taking a look at some recession metrics, well, they didn't pay a dividend in 07-09. So what we can see is they had around negative 4% sales in the last recession, which was above the average growth of companies in the S&P 500, which was negative to a larger degree. Now, dividend growth, very poor, 1% increase this year, negative 6% over the last 5 years. So they did have a dividend cut, in fact, twice from 17 to 18 and 18 to 19. But over the last 20 years at 23%. So that is positive if you have been a shareholder over the last 10 years. But the more recent acquisitions and investors would be looking at that as a negative. So something just to bear in mind, they've only also been paying increasing dividends for the last 2 years. Now, dividend yield theory, as always, states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. Forward P to AFFO, 10 versus 5-year average of 12.5, so another sign of undervaluation. And we can see Spirit Realty is lower than the P to AFFO of the real estate industry of 12.4. And as we said at the beginning of the episode, it is in the mid-range of the 52-week price range. But remember, as always, 52-week low does not signal undervaluation. 52-week high does not signal overvaluation. Now, AFFO is what we focus on when we look at REITs. Below 90% for REITs, what we can see for the large part, it is below that for Spirit Realty, which is positive to see, and in the low 70s over the more recent years and expected in 2023. Then adjusted funds from operation. This is a negative in my opinion. You don't want it to be going down $4 to $3.56. This is the wrong way any graph that you are looking at as an investor. So in fact, the adjusted funds from operation is decreasing over time, which is not really positive. So that is a slight worry, I would say. Sales growth for REITs, we look for 5 to 10%. Now, it's very interesting with this. Some years we have some phenomenal growth, double digit, followed then by large negative growth, then years of flat growth, and then so on and so on. So there are peaks and troughs to this company. Now, numerically speaking, what do we see? Well, 418 million in 2013, 710 in 2022. So they've nearly been able to double their top line over the last 10 years, but do note the inconsistencies throughout the years. Shares outstanding. Now, interestingly, this does look very similar to that of Realty Income, where they do a lot of share issuances. Now, this is very typical with REITs. It isn't what we normally expect for other companies, as we love it when investors do share buybacks, returning excess cash to our pockets. But what we can see, 51 million shares in 2013, 135 in 2022. So it does dilute your position as a shareholder, but they need to do this to issue equity to fund property acquisitions. Now, ROIC for REITs, 3 to 5% is what we look for. It gives us faith management are able to effectively allocate their capital, 10% or more for other companies. So I would say this is okay between that 3 to 5% that we look for. Operating margin, positive to see around that 40 to 50% continuously and consistently. So that is a positive. Now, one area that they do struggle, which does affect that dividend safety, is the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Above 5.5 is really a red flag indicator. It signals the number of years it would take the company to pay off all of their debt net of cash on hand. It was very high in 2013. It has started to come down, but in their most recent year, it's still above that 5.5. 2023, though, it is expected to come lower, so that is a positive, but something to be aware of. Now, before we jump into the valuation, we can do the exact same with Realty Income and just run through the details for those that are new or haven't seen this. Dividend safety score of 80, so it is safe. Market cap 36 billion, so it is a large cap company. In terms of their dividend metrics and the recession metrics in particular, they did increase this during 07-09. Recession sales fairly flat. Remember, that is above the average growth as companies in the S&P 500 had negative growth to a larger degree. And recession return negative 43%, so it did beat the S&P 500's negative 55, but still negative, which isn't great. Last full year, as always, I advocate 4% minimum if you can get that in your dividend increases, as that means it's in line with inflation, given the history of inflation and the rate. Last 5 years, 3%, so slightly lower than inflation. Last 20 years, above inflation at 5%. So it's not bad, not the greatest, but it isn't the worst. They are a dividend aristocrat, having paid dividends increasing year on year for the last 25 years or more. And then when we look at dividend yield theory, it does state that it is undervalued as that current yield is above that 5-year average. But remember, we don't look at any of these models in isolation. Likewise, forward P to AFFO 12 versus 18, and we can see it's roughly in line with the sector PE. And now remember, it is towards that 52-week low, but don't be buying any assets or anything just because it's near its 52-week low. That is not a signal for anything, especially undervaluation. Now, adjusted funds from operation payout, below 90%, it has been decreasing. So again, in the mid-60s, fairly similar to Spirit Realty. So that is a positive in relation to the dividend safety. Adjusted funds from operation, this is what you want to see. Consistent increases year on year, which we unfortunately didn't see with Spirit Realty. So it is a positive that this company at least is increasing that over time. Sales growth, 3 to 5%. For normal companies, 5 to 10% is what we look for REITs. Now, this has hit this Realty Income every single year, so that is very positive to see, with some years smashing that double digits very, very high at 60%, in fact, in the latest year. And we see that top line increasing from 780 million to 3.34 billion in 2022. Now, again, shares outstanding, as mentioned when the previous that we looked at, the Spirit Realty, 192 to 612. They are issuing shares very, very fast. Obviously, they need to do this to fund property acquisitions, but remember, this is diluting your position as a shareholder. ROIC between that 3 to 5%, so that is fairly positive. I would like that 21 year to be a one-off, as 2% is fairly low in my opinion. And finally, when we look at the operating margin, it is around that 50%, but it did drop slightly below 40 in 2022. As always, the higher the operating margin, the higher that bottom line net income should be in theory, and therefore offering those large dividend increases we love to see. Now, net debt to EBITDA below 5.5. This also has an issue that Spirit Realty has. It hasn't really been below that 5.5 consistently. 2022, this is a little bit too high for comfort, but it is expected to come down in 2023 to 5.19. Now, before we do jump into the valuations of both companies, we can take a very quick look at the comparison in the retail REITs industry for both companies. Now, year to date, what we can see, O has been down negative 18%, the worst performing in the industry, with Spirit Realty up around 1.34%, one of the best performers in the industry, but only up very slightly. Now, remember, as always, we do try to look at the last 5 years. When you do have the information available, do try and expand your analysis. But as always, we aren't looking at past performance as an indicator for the future. Now, over the last 5 years, O is up 2.5% total return, meaning those dividends reinvested. It isn't what we like to see, but remember, again, it is an indicator for the future. Spirit Realty up 25%, so one of the best performing in the industry as well, which is interesting when we do take a look at those financial metrics. Realty Income does seem to be slightly better. Now we can take a look at the valuations. We can jump straight into Spirit Realty. Now, typically what we would do is we'd run through every single one of these and we take a look at exactly their models, and then we get to our intrinsic value, which is just the average of these models that we have calculated. But don't forget, what we are doing is just jumping straight into the calculator for time purposes. So the intrinsic value is coming to $44. Now, this is based on the multiples valuation and the dividend discount model. Now, the current price for Spirit Realty is sitting around $38. Now, margin of safety, typically what we'd use is 10% if we believed it had a wide moat, strong financial metrics, good forward-looking data. It would mean a buy up to $40. Now, there are people who would be looking at a larger margin of safety, like myself, especially in the REIT industry, with the macroeconomic conditions, with those rising interest rates, with REITs that do have a significant amount of debt. So at 15%, it wouldn't really be a buy up until $37, which is slightly higher than the current trading price. And at 20%, it would be a buy at around $35. And 25% for those that are looking for value at $33. When we take a look at Spirit Realty Corp, we can see that is right there towards that 52-week low at $32. So as always, Wall Street, what are they saying? Well, they believe the share price to go up very slightly, though, at around 10% uplift to $41. But again, we aren't copying what Wall Street do. We always have to do our own due diligence. Now, when we take a look at Realty Income, jumping straight into the intrinsic value, and remember, it is the average of the models that we run through, it is coming to around $62.21. Now, the current price is sitting around $50. Margin of safety, again, we start off with 10%. It would be a buy up to $56, 15% up to $52, and those looking at 20%, a buy up to around $49, $50. Now, Realty Income is one that I do have in my portfolio, and it was one I was adding when it was below $50. And what are Wall Street saying? Well, they believe the share price to go up to around $62.80 over the next 12 months. So they do see that in line with our intrinsic value. As always, though, I'm very keen to hear your thoughts on Realty Income and the acquisition of Spirit Realty. Do you think these synergies will help out both of these companies in the long run? Are you looking to sell, or does this not even interest you after the acquisition? As always, if you want to grab a copy of the intrinsic value calculator to get to companies of your own acceptable buy price with your own margin of safety, then do click on that pinned comment and grab a copy. And if you do want to join us in the Patreon talking about all things buyers and sellers in the market, then do click on that Patreon link and we'll see you in the Discord. And finally, if you are enjoying the content, value is being provided, do hit that like button, do subscribe and hit the bell to be continually notified of these regular videos as they drop on your doorstep. As always, have a great day, catch you on the next episode and take care.